There was a moment in my trading journey when I lost everything. Not because the market crashed. Not because my strategy stopped working. And not because I didn't understand technical analysis. The real reason was something much simpler. A mistake I didn't even realize I was making. At the time, I thought I was doing everything correctly. I studied charts every day. I learned different trading strategies. I watched hours of trading videos. And when I entered a trade, I believed my analysis was solid. But slowly something strange started happening. My account kept shrinking, trade after trade, week after week, until one day I looked at my account and realized the capital was gone. For a long time, I blamed the market. I thought maybe the strategy was wrong. Maybe the market conditions had changed. Maybe trading just wasn't meant for me. But after reviewing hundreds of my past trades, I discovered something uncommon. The biggest mistake that destroyed my account had nothing to do with strategy. It was the way I thought about trading itself. And once I understood that mistake, everything about my approach to the market changed. In this video, I'm going to share the biggest mistake that cost me my entire trading capital, and why many traders are making the exact same mistake right now without realizing it. The strange thing about losing a trading account is that it rarely happens in one dramatic moment. Most people imagine a disaster. One huge trade, one reckless decision, one catastrophic mistake. But in reality, accounts usually die quietly. Slowly, almost invisibly. At the beginning, the losses felt normal. A losing trade here, another one there. I told myself this was part of trading. After all, every trader says the same thing, losses are normal. So I didn't worry too much. I simply kept trading. But something didn't feel right. The account wasn't collapsing suddenly. It was eroding, a little bit every week. Sometimes I would have a winning day, sometimes even a good week. And those moments gave me just enough hope to continue. I would think, maybe I've finally figured it out. But the next week the same pattern would return. Small losses. Unnecessary trades. Decisions that felt reasonable in the moment but wrong when I looked back later. The most dangerous part was that nothing felt obviously reckless. I wasn't gambling. I wasn't taking absurd risks. I believed I was trading seriously. I studied charts every day. I analyzed the market. I followed trading community. I tried to improve constantly. From the outside, it probably looked like dedication. But internally, something else was happening. I was slowly losing control of my decision-making. Not in obvious ways, in subtle ones. Moving a stop-loss just a little further. Entering a trade slightly earlier than planned. Taking an extra position because the setup looked good enough. Each decision seemed small. Each one felt justifiable. But over time, those small compromises started to compound. And the market is extremely unforgiving when small mistakes repeat over and over again. What made it even worse was the psychological loop. After every loss, I wanted to recover quickly. Not because I needed the money immediately, but because I wanted to prove to myself that I was still capable. That I hadn't wasted all the time I invested in learning. So I kept trading, trying to fix the problem through more activity, more analysis, more trades. But activity is not the same as improvement. And the market has a way of exposing that difference. Slowly, trade after trade. Until one day, I opened my trading account and saw something that forced me to stop. Most of the capital was gone. Not in a single disaster, but through a long sequence of small, repeated mistakes. And that was the moment I realized something uncommon. The biggest mistake that destroyed my account was not a technical. It was psychological. And once I understood what that mistake was, I began noticing the same pattern everywhere. In trading communities. In beginners. Even in experienced traders who were still struggling. The same mistake, repeated again and again, often without anyone realizing it. When I reviewed my past trades, I expected to find something technical. Maybe my entries were wrong. Maybe my analysis was weak. Maybe the strategy itself didn't work. But the more I looked at my trades, the more confused I became. Because many of the trades were actually correct. The setup was valid. The market context made sense. Sometimes the trade even moved in the expected direction. And yet somehow I still lost money. At first this made no sense to me. If the analysis was correct, why was the account still shrinking? That question stayed with me for a long time, until I came across an idea that completely changed the way I understood trading. An idea that Mark Douglas talks about in Trading in the Zone. Most traders enter the market believing something that feels logical. If their analysis is correct, the trade should work. But the market doesn't operate on certainty. It operates on probability. That means something very uncomfortable. You can do everything right and still lose the trade. And at the same time, you can make a terrible decision and still make money. This idea is extremely difficult for the human mind to accept. Because in most areas of life, outcomes follow logic. If you study well, you pass the exam. If you build something correctly, it works. But trading is different. In trading, a single outcome does not prove anything. One trade means almost nothing. When I looked at my behavior honestly, I realized something. I was treating every trade as if it had to prove something. If the trade won, it meant my analysis was good. If the trade lost, it meant I was wrong. So every trade carried emotional weight. And that emotional weight changed the way I behaved. After a losing trade, I wanted to recover quickly. After a winning trade, I felt confident and started taking more risk. I wasn't executing a system. I was reacting to outcome. The real mistake that destroyed my account was simple. I was trying to control the outcome of individual trades. But trading is not about controlling outcome. It's about executing a statistical edge over a series of trades. Once I understood this, something inside my mind shifted. A single trade stopped feeling important. It became just one event inside a long sequence. And this is exactly what Mark Douglas meant when he said, "The best traders think in probability." They don't expect every trade to work. They don't attach their identity to the result of one trade. They simply execute their system again and again, allowing the probabilities to play out over time. Once I understood this concept, I began noticing the same mistake everywhere. Traders constantly trying to prove they are right. Moving stop losses because they believe the analysis must work. Taking revenge trades to recover losses. Changing strategies after a few bad trades. All of these behaviors come from the same misunderstanding. Treating trading as if each trade should have a predictable outcome. But the market doesn't promise that. The only thing the market offers is probability. And the moment you truly accept that, your behavior changes. Once I understood that trading is a probabilistic game, another realization followed. If the outcome of a single trade is meaningless, and the only thing that truly matters is how you manage. Because risk management is what allows you to survive long enough for your edge to actually work. And that was the second lesson that completely changed my trading. Once I understood that a single trade means almost nothing, another realization followed. If the outcome of one trade is random, then the only thing that truly matters is survival. Because probability only works over a series of trades. Not one trade. Not two trades. But dozens, sometimes hundreds. And that was the second mistake I had been making without realizing it. I was risking too much on individual trades. At the time, every trade felt important. Every setup felt like it might be the one that would finally prove I understood the market. So when I saw something that looked like a strong opportunity, I would increase my risk. Just a little. Nothing reckless, I told myself. But that mindset contained a hidden trap. Because the moment you believe this trade matters more than the others, you stop thinking probabilistically. You start thinking emotionally. One of the most powerful ideas Mark Douglas explains is this. In a probabilistic system, you cannot know which trade will. Even if your system has an edge. You might have 5 losing trades in a row. Or 7. Or 10. And that sequence says nothing about the validity of the strategy. It's simply part of the distribution. But if your risk per trade is too large, something dangerous happens. Variance destroys you before probability has time to work. Most trading accounts don't disappear because of one bad idea. They disappear because of position sizing. Too much risk on a single outcome. When the trade-o is wrong, the loss is large. And once the account is damaged, emotions take control. The trader tries to recover faster, takes bigger trades, breaks their own rules, and the downward spiral begins. Professional traders see risk very differently. They don't think about how much they can make from a trade. They think about how much they are willing to lose. Before the trade even happens, that question changes everything, because it forces you to accept uncertainty before you enter the market. You already know what happens if you are wrong. And if you truly accept that risk, the outcome stops feeling personal. Once I began treating every trade as just one event in a long statistical sequence, my behavior changed. I stopped trying to prove my analysis. I stopped increasing risk when I felt confident. I stopped reacting emotionally to losses. Instead, I focused on something much simpler, executing the same process over and over again, trade after trade. And that's when I realized something that took years to understand. The biggest mistake that destroyed my account was not technical. It was psychological. I was trying to control outcomes in a game that is fundamentally uncertain. But once you accept uncertainty, trading becomes a completely different experience. And that's the final lesson most traders eventually learn. Looking back now, losing that account was painful. But it was also necessary, because it forced me to confront something I had been avoiding for a long time. The market was never the real problem. My mindset was. For a long time, I believed trading was about prediction, finding the perfect setup, reading the chart correctly, being smarter than the market. But the market doesn't reward the trader who tries to be right. It rewards the trader who can operate calmly inside uncertainty. And that realization forced me to ask myself a difficult question. Not about the market, about myself. Was I really trading a system, or was I just reacting emotionally to every outcome? Because when I looked honestly at my past trades, a pattern became obvious. I was not thinking in probabilities. I was thinking in individual outcomes. Every trade had to prove something. If it won, I felt confident. If it lost, I felt frustrated. And that emotional cycle quietly destroyed my discipline. But once I understood that trading is a probabilistic game, something inside my thinking shifted. A losing trade stopped feeling like failure. A winning trade stopped feeling like validation. Both became something much simpler. Just one outcome in a long sequence. And that's when I realized the biggest mistake that cost me my account. I wasn't losing because the strategy didn't work. I was losing because my behavior was incompatible with uncertainty. I wanted control in a place where control does not exist. And here's the uncomfortable truth. Most traders watching this video are probably making the same mistake right now. Not because they lack intelligence. Not because they haven't studied enough. But because their mind is still trying to force certainty onto an uncertain environment. So if you're serious about improving your trading, ask yourself this one question. When you enter a trade, do you truly accept the possibility of being wrong? Or are you secretly hoping the market proves you right? Because that difference is the line between an amateur trader and a professional. Trading becomes much easier the moment you stop trying to win every trade and start focusing on executing your edge over a series of trades. That's when probability finally begins working for you instead of against you. If this idea resonates with you, take a moment after this video and review your last 20 trades. Not the results, your behavior. Ask yourself honestly, did I follow my system or did I react emotionally to the outcome? You might discover something that changes the way you approach the market. And if you're interested in understanding the psychology behind consistent trading, consider subscribing. Because on this channel, we don't chase strategy. We study the mindset that allows traders to survive long enough for their edge to actually work.